So good morning, everybody. I'm Anthony, founder at SeedLegals. We're about 160 people. About a third of all early stage UK funding rounds now go through our platform. So don't go to a lawyer, come to SeedLegals. And importantly, we're here to show you not just building all the legals, but also the formula that will help get you funded, how much equity to dilute, how to value yourself, and so on. But today I'm not here to pitch SeedLegals. I'm here to do a brain dump from all the founders and all the funding rounds I've seen so that you get there faster.
So we want to make this as interactive and helpful as possible. So I'll go through a few topics which I think will be useful based on this previous week, and then everyone else will just go into an open Q&A, so you can pick Anthony's brain about anything, pop questions in the chat, raise your hand, and then once we've gone through all the questions, if we do have some time at the end, we'll do a bit more pitch practice. So should we just start talking about agile fundraising and just kind of high level what that actually means for a founder and the benefits to a founder of an agile raise?
Sure. So my favorite topic, because it's going to make life so much easier for every founder. So everyone in the room is probably thinking exactly the same thing. I need to raise money for my startup. And then the next question is, how much do I need to raise? So I think what you normally do is you do the following. You go, well, fundraising is slow and expensive and complicated, and I have to spend all this time looking for investors. So I'm not running my business. So I don't want to do it very often. So I'm going to raise for like 18 months. So how much do I need to raise? Well, let's say over the next 18 months, I need 2 developers, I need a product person, I need a salesperson, a marketing person, a data person, and of course the 2 founders, we need to pay a salary. So that's 8 people. I think the number always comes to 8. And then we need to get paid maybe 50K each, including, outgoings and offers. So that's 400K a year I need 18 months. I need to raise 600K. Awesome. Small problem. When you do a funding round, of course, you're selling or giving away equity. And your goal is to dilute around 15% in each funding round. So if you have 3 funding rounds over the life of your company, you're diluting, 0.85 to the power of 3. So after 3 funding rounds, the founders will have 56%, more than half of the shares in the company. So the founders being majority shareholders is desirable. So if you think the goal, again, 3 funding rounds, after which you're profitable, you don't need to fundraise, or you're good to sell your company, 15% in each funding round is desirable. If you are selling 15% of the company, this means the valuation, the so-called pre-money valuation, is 5 times the amount of money you want to raise. Why? Because at the end of the funding round, the investors will own 1 in 6, 16% of the company. So now you go, great, I need to raise 600K, multiply that by 5 for 15% dilution, 3 million pre-money valuation. So you go off to investors and you go, great, I'm looking to raise, and they go, oh, nice, what's the valuation? You go, 3 million. And they go, oh, awesome, what's your revenue? And you go, no, I don't have any revenue yet. And they go, well, how many customers do you have? And you go, oh, no, I don't have any customers yet. Well, have you built it? Well, we're working on it. And they go, love what you're doing, come back later, because the valuation at that point is too high. The other thing is, so if you want to raise at a lower valuation, you have to raise less money. So your quandary is, number one, do I do a small round now and a big round later, or try to do a bigger round right now? The other thing is that if you're raising, even 200,000 or 300,000 pounds, you're probably raising from angel investors. And that means their ticket size, their investment size might be 5K to, 50K, but usually on the sort of 5 to 20K range, which means you are probably raising from, half dozen to 20 investors. And obviously it takes time to find these investors. And what you really wanted, having 300,000 in the bank is awesome, but what you really wanted is like 50,000 now, so you can start hiring that developer or outsourcing the development or whatever you're doing. So wouldn't it be great if, instead of saying I have to get all the investors on the bus together in July to leave with the big funding round, if when I met someone at an event and they went, hey, can I invest in your company? And you go, great, let me send you a seed fast. So agile fundraising is really a pattern that's emerged principally over the last 3 years, where ahead of a funding round, you're raising from individual investors. Your goal is still to do the funding round. They convert in the funding round, and then you top up the funding round and keep going afterwards. So the funding round has actually become the exception rather than the norm. And just before I go back to Purdy and MA, my favorite example of this in action is Sophia from Sourdough Sophia Bakery in Hackney. And she wanted to raise for her bakery. She's obviously a baker, not a fintech person. So in the past, finding all the investors and doing all the funding legals would have been quite complicated, but she discovered SeedLegals, and I was delighted to see in our Slack channel that she was buying lots of seed fasts. And what she did is she raised £200,000 with 100 individual investors. And she was doing these seed fasts like at the rate of 3 or 4 or 5 a day, sometimes 1 an hour or so. And I was convinced everyone who came into her bakery, she said, would you like a baguette, a croissant, and can I give you an investment agreement as well? And she was raising like 2K here and 1K there, and she raised 200K and then converted in a funding round later to build more bakeries. So that to me was the perfect example of anytime you have lots of friends and family, customers, LinkedIn, TikTok, Insta Reach, wherever you can find people, your goal is to make as much noise as possible and then turn those into investment that you can use now ahead of a funding round later. So that was my lengthy discussion on agile fundraising.
That's really useful. Thank you. So when you were talking about the do you have revenue? No. Do you have customers? No. Do you have tech? No thing. For a pre-seed founder who is pre-revenue and maybe has some beta users but not customers yet, what are the average numbers you're seeing in terms of the fundraise amount and then the kind of average valuation at that stage?
Great point. So I think funding rounds go into a few stages, and we all hear the terms pre-seed and seed and so on. I don't care much for the terms, but I think the pattern more or less is this, which is number one, founders have to put some money of their own into the business before anyone else will put money in. Why? Because few people invest just on a PowerPoint. They want you to build a prototype, validate it, and so on. So our SeedLegals data shows founders put a median of £26,000 of their own money into the business to build something more than a PowerPoint. That's the first thing. And then you might raise 50 or 70,000 pounds or thereabouts from friends and family, people just enough to get that outsourced prototype made because you just can't afford to spend more of your own money on it, or the rate at which you can fund it is limiting its growth. So that is the friends and family round, so to speak. And by the way, you don't need to do all of these rounds. You might skip some, but that's sort of a pattern generally that I see. The next one after that used to be the £150,000 SEIS round. Now it's more like the £250,000 SEIS round, partially because SEIS limit has gone up and partially because everything's more expensive. So there you're going to be raising from angel investors. I would call that an angel round. And you're probably going to find people in an extended network, or you're going to post on social saying that you're fundraising or your business. Or you might use services like scribelabs.ai to find investors, or you might reach out to syndicates and an investor finds investors for you. But that's the classic angel round, 250K SEIS. And then you might do the 500 to 700,000 pound seed round once you've got a product. And then once you've got revenue, then you'll raise a few million in Series A. And each time you might be thinking you're going to raise 3 to 5 times the amount of the last round at 3 to 5 times the valuation. And if that's the pattern that you have in mind, and of course, filling in with, agile, so that instead of it being a single spike, you're raising in stages towards that and then topping up afterwards. So those would be the standard patterns I would see.
Perfect, really useful. And can you just run over very quickly SEIS as well, and who qualifies, and if you're a founder applying, kind of generally what you need to do?
So I'm assuming somewhat that everyone knows about SEIs. There was some stat that only like 3% of people overall know about SEIs. So SEIs is a fantastic government initiative to incentivize investors to invest in risky startups. So as an investor, if you invest in a company that offers you SEIS, you can deduct 50% of your investment amount from your income taxable amount from this year. And what many people don't know is you can also backdate it to your previous tax year. And as an investor, you can have up to £200,000 of these deductions that you can make, or £200,000 of investments. So you can take £100,000 max off your taxable income for this year or the last tax year. And a company can raise up to £250,000 like this. Once you've used up your SEIS, you can go on to EIS, and there the investor can deduct 30% of the investment amount from their taxable income. And you as a company can raise up to 15, 12 million pounds, enough that carries you on for a while. And you can, with SEIS, you have to be in trading for less than 3 years, and for EIS for less than 7 years. And in both cases, investors can, if they keep their shares for 3 years and sell them afterwards, they'll pay no capital gains tax. And if your company goes bankrupt, then they can also write off their investment against their tax with loss relief. So overall, it's a massive de-risker for investors. And the vast majority, I'd say 80% of all investment in companies in rounds of less than 500K in the UK are angel investors investing for these SEIs or tax benefits, or groups like Startup Funding Club, Hatch, Q Ventures, and others, which are SEIS, EIS funds, which will find a group of angel investors and then they will invest. And they'll usually invest £250,000 and take all of your SEIS. So the last thing to know about SEIS is, when you are in your pitch deck, you want to put, offering SEIS or EIS. That's super important. That's often the difference between investors going, yep, I'm in, or the eyes glazing over and moving to a pitch deck from someone else. But if you want to tell your investor reliably that they will definitely be able to get SEIS or EIS, then you need to get advance assurance. So advance assurance is where you write to HMRC and they give you a letter that says this company has pre-qualified to be able to offer SEIS or EIS. Now, the advance assurance isn't legally required. It's a comfort letter for investors. You can definitely take investment, and after your round, you do what's called SEIS or EIS compliance, where you write to HMRC again, and they give the special code number, and then you generate a certificate that gets sent to the investor, and they use that when they claim their tax relief. But the advance assurance is often the difference between the investor going, I'm in, or call me when you've got your advance assurance. So although it's not legally required, a good number of investors will say, call me when you've got your advance assurance, so I know that you can offer it. And you can do this on the HMRC site. It's a bit more complicated. Success rates are, from the HMRC stats, about 67%. We do it on SeedLegals. More than 50% of all of them are now done through SeedLegals. It's like 99%. So it's definitely something worth doing, even though it's not legally required, but simply because most investors these days expect it.
Thank you. That's really useful. If anyone has any questions on the numbers, valuation, raise amount, SEIS, anything that we've just talked about in the last 15 minutes, pop it in the chat, because I'm going to move on to a few other topics. So Engin actually just posted in the chat, if you can talk a bit about kind of a clean cap table. So with your bakery anecdote that you just gave,
right,
having 100 individual angels then on a cap table, how do you clean it up and how do you kind of make it as efficient as possible?
Anthony,
right,
the new product offering from SeedLegals, which I love.
Exactly. So there's this concept called a clean cap table, and a clean cap table definitions vary. But one of them is that you don't have too many small investors or shareholders on your cap table. Another is that the founders don't have too little equity. or that the investors have too many preference shares and so on. So when you're doing your funding round, not your first round, but your second or third round, your investors will say, send us your cap table, your share register. And, they'll generally be expecting to see it, if you sort it by number of shares, most at the top, they'll generally be expecting to see the founders and then the lead investor and then some other investors. But if it turns out the founders have got too little equity, that's a bad sign, because they know that after the next round, the founders have got too little skin in the game and your company becomes uninvestable if you've given away too much equity at the beginning. Some investors also want to see lots of the smaller investors packaged up into one entity. I'm not convinced this is a big thing. On SeedLegals, we've got, I think, 40 or so shareholders. I love the concept of lots of smaller shareholders instead of one big shareholder, because some things need investor consent. And instead of having one person with a veto right, you can have like any 10 of 20 people. This goes by number of shares, not just number of people, but assuming they've got similar number of shares, any half of them agreeing and you're in. And when you've got lots of small shareholders, they're not looking for a board seat and preference shares. So my preference is multiple smaller shareholders or investors rather than one bigger one. Obviously, for raising millions, you need to go to a VC. But in the case of more than, let's say, 30 or so, it becomes tempting to say, what if I could just wrap them up into one item on the cap table? And we call that a roll-up. Sometimes it's called an SPV, special purpose vehicle, or a nominee. And we've productized that. So if you're doing a funding round on SeedLegals, you can just add them in the funding round and go, these ones all in a roll-up, and then we run the nominee, and they all appear as one entry on your cap table. So when you go to investors later, they go, oh, great, there's only like 5 people in the share register. So that roll-up is something that you can have. And in the case of creating seed fasts, when you create a seed fast, that's an agreement to say, I'm giving you money now, you'll give me shares later. You can add an option in it to go, and by the way, the person is agreeing that you can convert them into shares in a roll-up later. So roll-ups have gone from like nobody's doing them to actually quite fashionable, which is why we've productized it to make it easier.
Thank you. There's a few other questions coming in about the advanced assurance. So a few things, how long does it typically take? I guess at what point in the process of fundraising should you apply for it? Like, do you need to have an investor on board before you apply? And then what's the cost was another question.
Right. So what happens is once upon a time, advanced assurance was like only in exceptional cases. It was like edge cases. And so hardly anyone applied. And then it became fashionable that investors said, we want you to have advanced assurance. And then everyone applied, even if they weren't doing a funding round. And then HMRC had so many incomings, they started year by year increasing the bar for doing advanced assurance. So now they say when you apply for advanced assurance, you have to show investor intent for at least about a third of the amount you want to apply for. So let's say that you want to apply for 250K. By the way, when you're doing your advanced assurance, if you think of raising more than 200K, I would apply for 300K of advanced assurance, which is more than the 250K SEIS amount, in which case you'll get SEIS and EIS advanced assurance. So you can tell your investors, yes, I've got SEIS and EIS, even to continue topping up the round afterwards. But when you apply for advanced assurance, you need to provide name and address and intended investment amount for up to about a third of the amount. So if you're applying for 300K of advanced assurance, you need to show investor intent for about 100K. And these don't need to be committed investors because they often will be contingent on you getting your advanced assurance. But because it's HMRC, you don't want to make stuff up as you go along. Now, most investors, most everyone is eligible to be an SEIS investor if they are a UK taxpayer. Your children or your parents are not, and your wife isn't, but girlfriends are. So if you have a girlfriend as an SEIS investor, you've got a dilemma because you can't get married or they lose their SEIS, tough things in life. But if you again, don't make up things. But if you do have investors that are family, if they've got the same surname, make clear in the application the relative that it is, so that HMRC don't write back and go, is that a parent or a child? So how long will the process take? Typically, HMRC get back in probably 2 or 3 weeks. We've seen some in as little as 5 days. Sometimes they query things and it takes longer. Anytime these days it used to be anytime there was blockchain, it would get queried a bit more. These days, often AI things surprisingly get queried, because what's happened is companies, HMRCs, that AI is mostly, I'm just using ChatGPT, and they're looking for things that are growth things. So the bar is quite low. But if you're using AI, try and make sure it looks like a sort of more deeper AI rather than we just use ChatGPT, because again, it's designed to fuel growth startups. And there was one question, which is how much does it cost? On SeedLegals, we charge £390 for the advance assurance, but if you have one of our Plus packages, it's included for free. Either an advance assurance or compliance is included in the Plus package, so the cost isn't huge. And sort of as an insurance, so when you talk to investors to say the magic words, I've got my SEIS advanced insurance, I think it's worthwhile.
Awesome. There was another question which you kind of answered, but I'm going to ask explicitly as well, just in case there's a different answer. How do you overcome the need for the interested investor when you want to put it on your deck to entice investors?
Right. So this is a bit of a catch-22, right? Which is, you're looking for investors. You want to get your advance assurance so you can get investors, but investors will only come along once you've got advance assurance. And I don't have the magic answer for getting out of the catch-22, but broadly, when somebody's somewhat interested, you go, can I use your name for the advance assurance application? There's no commitment, but I have to, in order to get it, I need to put some investor names. Can I use yours? So I think it's, in my take, you shouldn't put someone's name unless they know. I've never seen HMRC reach out to anybody, but it is HMRC. So, again, I think you might actually leverage this as that nice step, as a sort of pre-commitment step. Hey, there's no commitment needed. Are you okay if I put your name down? If the person says yes, then that's a nice little vote of confidence without being the commitment. So you might try and leverage it.
Awesome. Thank you so much. Another question from the chat. So Jennifer Wild has a business registered in London, but she's spoken with angels all around the world that have said that they want to put money into the business. Is this possible, is the question. And I guess any detail on how you then take the money would be valuable.
Great question. So I'd think about maybe 20% of investors we see on SeedLegals, they're not in the UK. The great thing is it doesn't matter where the investor is. Your company, if it's a UK company, everything will be English law, and you'll use exactly the same investment agreement. So if you're on SeedLegals, you're just going to make a seed fast or add them in the funding round, and it makes no difference where they are. Everything's e-signed anyway, and everything's shared, by email anyway. So the days of somebody who need to be local is irrelevant. There are a couple of things to think about. One, any foreign investor isn't going to get SEIS or EIS, so that leaves more SEIS available for your local investors. The other thing to note is sometimes foreign investors have different expectations in a funding round for the deal terms they get, and that's an important thing to know, because typically in the rest of the world, investors expect to get preference shares. So as founders, when you start your company, you've got ordinary shares. What's an ordinary share? It says when you sell your company, let's say for £10 million, everyone gets that proceeds of sale pro rata, proportional to their shareholding. So if you've got 30% of the shares, you get 30% of the sale price. A preference share says I get my investment money back first, and then everyone else distributes the rest of it, or that's called a participating preference, or I get the better of my money back or my percent equity back. So preference shares protect investors on a low value exit of the company. And around the world, it's pretty standard that investors get preference shares. But in the UK, in order to qualify for SEIS or EIS, you have to take what's called the ordinary risks of an investor. And that means investors here typically get ordinary shares. So it's actually better for you as founders because some exits are for really high values, some are for low values. And if you exit your business for about the same amount that you've raised in total, and all of your investors have got preference shares, they get their money back first, and you could end up with very little. So your goal is ideally, as long as possible, because later on VCs are going to insist on preference shares, but to give out ordinary shares. So the reason I'm mentioning this is if you have foreign investors, they will start off by probably expecting preference shares, and then you're going to have to spend a little time to try and educate them. This works half the time to say, you know, all my investors in the UK are getting ordinary shares. This is the standard pattern here. Can I give you ordinary shares? Or you might be a bit more aggressive on that. But apart from that, it makes no difference where they are. And the last thing to note is that, of course, if they are elsewhere, they might, how are you going to, you know, what currency are you going to designate the investment? And you always want to ultimately to be in pounds because all your UK investors are in pounds. Your valuation is in pounds, unless you're doing everything in dollars. And so when you negotiate their investment, you might discuss with them you're investing $100,000, but the deal documents are going to say you're going to send £82,000 and 73p or whatever it is, and you might decide to that between yourselves that you designate their $100,000 to be this amount that you see. So even if, you know, Wise charges you more or less fees and so on, that's the amount that they are investing. And then last thing, by the way, use Wise rather than a high street bank for the Forex, because the high street bank will kill you on fees. And so, you know, and then you can super easily set up a US dollar or any currency Wise or Airwallex account.
Good tip. I'm going to move on to totally separate topic. So again, if anyone has any specific questions on that topic, post them in the chat. Co-founder agreements, or if you're bringing on your first couple of hires and you want to give them agreement, can you just talk a bit about the agreement? And then if someone is allocating shares for employees and vesting and all of that kind of stuff.
Right. So we've all watched, whether it be Succession or the Facebook saga or whatever, and we all think we're going to get screwed by our investors. Turns out you're mostly screwed by your co-founders. So everyone's sitting there trying to go look at shareholder agreement going, where's the investor trying to screw me? Of course, if you do it on SeedLegals, you're driving and you set the deal terms. But the biggest problem is founder fallouts, and maybe 10 or 20% of the time, founders fall out. And imagine two founders, you've got 50 shares each. There's a fallout, you can't get along, product takes longer, the marketing person's got nothing to do, the tech person's doing all the work, someone's got their bills to pay, they leave, whatever it might be. If you don't have a vesting schedule, it means the person who leaves by default keeps all their shares, and then your business is uninvestable. So what you want is, if you've got more than one founder, you want everyone to sign a founder agreement. And a founder agreement has a few key provisions in it. It says, number one, if I leave in N years, typically 3 years, could be 4 years, I have to give back some of my shares, the unvested shares, and that's called reverse vesting or just vesting for short. And typically, you'd say when you start your company, you might have what's called 3-year straight line vesting, which means if I leave anytime in the first 3 years, I have to give back that proportion of my shares. So if I leave after 1 year, I keep a third, have to return 2/3, and the company will cancel those shares typically, and then it may issue more shares to a new co-founder or, you know, late joining employee founder and so on. Another pattern for vesting, which investors will often insist on, or accelerators will often insist on, is 4-year with a 1-year cliff. So this means your shares will vest for over 4 years, but if you leave in the first year, you get nothing. If you stay, and then at the beginning of the end of the first year, suddenly you own 25%, and then it keeps going up month by month. So the idea with 4 years and a 1-year cliff is to say, particularly in accelerators where founders get together as part of the accelerator, you don't want the case that somebody sticks around for a few months, doesn't work out, they were no good from the start, and they still end up with 3% equity that irks you forevermore. So it's a bit of a double or quits game. But you want to be careful if a fund, so let's say you've been working together for a year, you put your life into it, you raise investment, and then your investor says, I want 4 years with a 1-year cliff. This means if anything goes wrong in the next year, and sometimes things go wrong right after you've gotten funding, because then suddenly you've got the pressure of building the business and accelerating growth. If you leave in that period, you lose everything. So I'm not a big fan of the cliff, at least for a founder. So the first thing was the vesting. The second thing is IP assignment, so that all your intellectual property that you've developed when you're in the pub or doing things on your own is now owned by the company. And later on, when you get a VC as an investor, they're going to, as part of their due diligence, want to make sure that everyone who's done any work for the company has signed an agreement with the company that includes the intellectual property being assigned to the company. And if you can't, as part of your due diligence, show that each person who's worked on the project has signed an agreement with the company, then it creates a lot of friction in your round. The investor might want to reduce the valuation. You have to chase up people who are now traveling in the Sahara or something to try and get them to do an agreement when you had an acrimonious dispute with them. So make sure everybody who does anything on your company, any work, has signed a consulting agreement, advisor, employment, or a founder agreement. And all of these are available on SeedLegals, and I'm not pushing SeedLegals. It just makes that entire problem space disappear. And then the last thing also in a founder agreement would be a non-solicitation and non-compete, because you also don't want your leaving co-founder to disappear and then go, great, I'm just going to do the same as you're doing because that's what I want to do. Now, I should point out that all of these founder agreement terms are double-edged swords, because if your co-founder leaves, you're going, bastard, I don't want them to have their share. But if you leave, you're going, I want my share. So be careful on all of these things. Now, the other one is an employment agreement. And when you have an employee, of course, you're going to pay them cash, but you also want to, you're competing with other companies to hire talent. So can you give them share options? You typically won't give them shares, but you'll give them share options. And in the UK, there's another HMRC initiative called the EMI, Enterprise Management Incentive, EMI Options Scheme, which is a very tax generous scheme for employees. And if you give them share options with an EMI scheme, then it means the employee pays only 10% capital gains tax on the gain when they sell their shares later. They pay no taxes on it before then, because otherwise actually there could be taxes, and the company pays no taxes on it. So it's a very generous scheme, and just 10% capital gains tax, no income tax when you sell the shares later, could be a nice windfall. So with employees, you might instead, with founders, I said you don't want to do 4 years and a 1-year cliff, because as founders, most of your value in the business is your equity. You may not get paid much or anything at the beginning, but employees are usually paid, at least close to market rate. And so options are a sweetener for them. So there you might say, if you leave in the first year, you get nothing. I'm only going to incentivize people who are going to be with us for the longer term. So you can come up with different rules for giving share options to your team.
Thank you. Another question in the chat, based back on the fundraising topic. If you plan for your startup to go global and you're looking to launch into the US, is it better to complete your pre-seed round as a US fundraise, I guess using USD, or articulating it as USD to make it easier to make the next move?
Right, great question. So I would, there's something called the Delaware flip, which is you have a UK company you start with because it's super easy, and then you flip to the US to get US investment later. I've got webinars on pretty much everything. So if you Google, SeedLegals scale-wise, or SeedLegals expanding to the US, or SeedLegals Daniel Glazer, he's a lawyer from Wilson Sonsini, there are videos and webinars on how to expand to the US, set up a company in the US, build your sales team in the US, But the short answer of it is, and the advice from Daniel Glazer, Wilson Sonsini, the big US law firm that does all the big VC deals and so on, is, there's sort of two good times to go to the US and one less useful one. The first one is get on a plane and go off to Silicon Valley and work in a garage and be part of the US scene. Or two, raise your Series A and beyond here, get 10, 20 million a year in revenue from the UK market, and then go and launch in the US. But the bit where you're still finding product market fit in the UK and you don't have much revenue, US investors typically will only be interested in investing in a UK company to scale it to the US. And if they see you're still working on scaling here, it's going to be a lot less likely they would invest. Investors usually invest in their own country, less so other countries. I mean, as I said, about 20% of investment I see on SeedLegals from elsewhere, but the majority you should expect to come from your company, your country. So the general pattern is, in the UK, you can incorporate. You've probably already done that on Companies House. It's super easy. The US is a minefield of 50 states and different laws, and you're going to spend fortunes on legals. And I would much rather spend £12. They've recently upped the rate, so it's £50 to start a company in the UK. It takes 30 minutes. You're sorted. Focus on the main mission, which is getting people to want what you're building, not moving all the puzzle pieces and paying lawyers. But the principal reason for flipping to a US company in the early stages is that you get into textiles or YC and they, insist on it. Going back to the question is, what if most of my investment is from US investors into my UK company? Should I price my entire funding round in dollars? And the answer is, sure, you could do that. If a UK investor sees a pitch deck that shows dollar amounts, they're going to assume, rightly or wrongly, that you won't qualify for SEIS. And if they're looking for that, they'll probably, move on to the next one. Maybe they'll ask you. So my take is, if you're looking to attract UK investors, price the thing in pounds, because that is just going to make it look, local. And otherwise, they'll put it as any random, US company. Doesn't mean you can't do the round in dollars, but think about everything in your pitch deck as being signaling for the investor, and a pound amount will signal, SEIS or EIS.
Thank you. Another question from the chat from Lorenzo. There was recent updates to the SEIS and EIS regulations. Maybe run through anything that's useful for the other founders to know. But the question is, do you think there will be any more changes in the near future?
There won't be any more changes in the near future. I can say that for certain because the government said these are the changes. So they basically increased the SEIS amount from 150 to 250,000 pounds, and you had to be in trading previously for 2 years, and now it's 3 years. And there was a possibility that EIS would expire not expire for, but you wouldn't be able to offer EIS starting from 2025 onwards. And they've said that that's confirmed. So there's nothing that's going to change anytime soon.
Thank you. I think there's some other questions which are being answered in the chat by Engin. Thank you very much for adding some extra detail. If anybody else has any last minute questions, please do raise your hand or post it in the chat. If not, we're going to go through the final 2 pitch decks and get some feedback from both Anthony and Engin. Anthony, this cohort, it might be that they're pitching it for the very first time. So we're just saying some constructive feedback, as constructive as it can be, but under the. So
you're saying be nice. I
be
got
nice.
it. Okay.
Yeah. So.
And by the way, briefly, if you Google SeedLegals pitch deck clinic, back during COVID lockdown, I recorded a series of like 12 videos with founders who wanted to pitch deck review, and in the nicest, hopeful way, went through it. And, there are all these articles on how to create a great pitch deck. None of them are really useful. All those things saying this was Uber's first pitch deck. If they've got a graph that goes up to the right, and shows billions, it doesn't matter what the rest says. So those are useless as well. But the best is to look at someone else's pitch deck, as we're going to do now. But if you look at the pitch deck clinic series, I think it's quite interesting, because then suddenly you'll look at your own pitch deck in a new light. But with that out of the way, let's look at some pitch decks.
A quick
Anthony,
one.
hindsight is 2020, right? It's easy to look at the Uber deck after Uber has become Uber.
Exactly.
Whilst we're just going to get the first one loaded up, there's a question that's just come in from Ian about the rules, the new regulations for high net worth individuals and self-certified investors, and who, as a startup, you can approach as an angel investor and promote yourself as a business. Any thoughts on that?
This is a really great point and a hot topic. So essentially, if you're doing a financial promotion, if you're going out and saying, we're fundraising, then you're only meant to be able to pitch that to high net worth or sophisticated investors. A high net worth investor is somebody who had said they earned more than £100,000 a year. That rule's recently changed to more than £200,000 a year, £170,000 a year, I should say. Or they're a sophisticated investor, which means that it used to be that they've invested in at least one other company or something, but that they're a member of some angel club, or they've got some other things. Anyway, the short answer is most people are probably neither high net worth nor sophisticated investors. And so the question is, does this make it more difficult to fundraise? So realistically, on SeedLegals, I would say pretty much zero people take their investors through that process. I'm not saying you should or you shouldn't, but you meet somebody, you go, would you like to invest in my company? Let me send you a seed fast. And that's it. So the rules changed about a month ago to increase the bar for an investor, meeting these rules, the rules of self-certification. So if you create a pitch page on SeedLegals and you share your pitch information, because we have to, when people click through to see your pitch page, they have to click the form saying I'm a high net worth or sophisticated investor. And I mean, they could just click it regardless whether they want to or not. But we have to show that. If you go and talk to somebody directly, then you're probably not going to ask them to do any of that. And my take on SeedLegals is there's been a lot of noise from people who run syndicates who are forced to go through these rules to say that it will disadvantage female investors and things like that. However, looking at fundraising on SeedLegals, which is hugely up in January, things are picking up, which is fantastic. I see zero founders being affected by this. So that's my short answer on the changes.
If I can add 20 seconds on that. If you do have friends and family you would like to bring on as angel investors, the UK BAA has launched a new 6-month free membership program for anyone to sign off who doesn't meet the income level criteria to essentially become a self-certified angel investor. So I just posted the link. Look at that. Anyone can. Well, I'll stop there. I won't give more details.
Friends and family also fall outside of this.
Sorry, that was a bad way to intro. For any angel investors who may not be meeting the income level or net worth requirements, there are other ways to self-certify.
And there'll be a bunch of information on this online, but it is kind of still changing, and there's a lot of lobbying going on to the government right now, so it might still change in the coming weeks. I'm just going to stop recording.
It won't change in the coming weeks.
That's a shame.